Good afternoon, everyone. Due to the storms last week, we were not able to hold this webinar as originally scheduled. This is a later recording of the beginning of the year tax planning webinar by Extension Tax Specialist J.C. Hobbs. This is part of our ongoing Learn at Lunch webinar. For additional farm management resources, please visit the eFarm Management website, and I will paste this link into the chat box in the lower left corner. JC, I will turn it over to you now.
Thanks, Brent. Well, welcome everyone. Our subject today is talking about beginning of year income tax management. Now, some of the things that we will get into in this discussion will affect the prior year, but it also has an impact on future years. So we're going to touch upon different things here and kind of give you an idea of what all is going on in terms of managing taxes from the point of view of January, February, March, which is not the typical time we think about tax management. So again, we're going to look at what affects the current year and future years. Some of the topics that I've included here, we don't think about as often as some of the other things that we do. For example, the first one is Code Section 180. That allows a farmer to elect to deduct fertilizer and lime expense in the year that it is put on the farm versus capitalizing that cost over the life of that particular item. So if phosphorus is going to last 2 or 3 years, you capitalize it, you basically spread the cost over a period of time. The same with lime. We'll talk about some depreciation tools, how those can impact, again, current year. And looking forward, some can go as long as, well, depending upon the asset, most of the time we think of about 15. Also, farm net operating losses. Now, the rules have changed under the current law, so this Tax Cuts and Jobs Act made some significant adjustments in the farm net operating loss treatment, and we'll talk about those. But again, if you look at it, it has the ability to affect, it does impact the current year, the past through a carryback, the future through a carry forward. We'll also hit a little bit on if you have high income, what funding retirement can do to minimize or reduce taxes, adjust them. And then hit upon the idea of income averaging and how that works as a planning tool for the current year. Let's talk about the first one, capitalizing versus deducting fertilizer and lime. The tax code reads that if a benefit lasts more than 1 year, a farmer can elect to capitalize that cost over the useful life of the item, or elect to deduct it as an expense in the year paid. Most farmers, by default, most of the tax preparers by default, elect to deduct it in the year paid because it's very simple. You just file it on the return as an expense. However, if it's necessary or would be helpful, if you've got low income this year and you expect income to increase in the future, it is often a benefit to take that expense and capitalize it, move some of the recapture into future years, so you stretch the cost of recovery over a period of years, and basically it allows you to then manage taxable income in the current and the future. Now the idea is this is an annual election, so what we do this year we can change. If we buy more fertilizer next year, we can change to a different election. So it's a unique tool, not often talked about, very seldom talked about, and very seldom used, but it does have a great benefit in times when we do have large amounts of income expected in the future, and we need to have some offsetting expenses in those years. Now, depreciation. A lot of considerations to be made here because basically you've got all kinds of options, and these options have increased, or the number of alternatives have increased for different assets under the new tax law. So what we're looking at, we're basically selecting the current year has implications for future years by essentially how long do we spread the cost out, how fast do we recover it. We're looking at then how we select those different tools based upon what we expect income to be in the future. Sometimes this is next to impossible to predict, but there are times when we know we've got an oil well being drilled. We expect income to be large. We had a large amount of lease bonus that's going to pop up, things like that. So a large amount not expected to happen again. That has one set of rules that we will apply. If we expect taxable income to be increasing over years or stable or decreasing, these all have different or influence the depreciation method we would select. Let's make life easy. Let's look at one of the options or the options that are allowed right now for a new item placed in service. New machinery and equipment rules have changed. Also, the tax law has allowed farmers to elect to use full 200% declining balance. We haven't had this opportunity since the 1986 Act. In that time, we ended up farmers having to use the slower write-off 150% declining balance. So consequently, the new law, we can write things off faster or at much greater amounts in early years, lesser in later years. And the new rules, or for new assets, we're also allowed to write them off even faster. So if you'll notice first and third columns, 5-year items. If it's new tractors, new machinery, new equipment, we can write it off over 5 years using either the 200 or 150. We can also select to reduce it over 7 years, so it can be a 200% over 7, 150% over 7, or the straight line GDS over 7. We can also use the alternate depreciation system, which lets us take that same tractor and depreciate it over 10 years, or bonus, where we can write off 100% in the year placed in service and purchased. Section 179, the same thing. We can elect up to 100% of the cost that we can apply in the year we buy it, place it in service, or we can use some percentage. So basically, if you look at the bottom, can elect to use less than the $100,000. If we only have $50,000 of taxable income, or let's say $75,000 of taxable income, we can use bonus or 179 on 75,000 and carry the rest of it over. Or we can even use, say, depreciate 50,000 using 179 and depreciate the rest of it using one of the other 5 prior methods. So there's all kinds of alternatives that farmers can pick and choose from under the current law. So what are capital assets? So we can depreciate capital assets, and that is anything with a useful life greater than 1 year. Those costs are allowed to be covered by claiming a depreciation expense over the useful life of the asset. Well, that's typically set up by the IRS. They have their class lives. If you'll look at the general depreciation system there at the next line, talks about most of our equipment, machinery, livestock, buildings, etc. Depending upon what the asset is, what the class life is, can be as short as 3 years or as long as 39 years from some buildings. Most of our farm assets will fall in the 3, 5, 7, 10-year lives. Some will fall in the 20, 27 and a half, but those are typically buildings and structures that are multi-purpose, multi-use. The alternate depreciation system basically allows any of those asset lives to be extended. So beef and dairy cows is an example. Those are 5-year assets. By making the election to use the alternate depreciation system, we're now going to depreciate those over 7 years. So there's all kinds of options, alternatives, unique scenarios that we can use here to manage taxable income. So let's look at some of these. How accelerated depreciation. So we can write it off quicker. Write it off in the year that we buy it. Those are the 179 rules. That's the first bullet. The second one looks at the bonus depreciation rules. Now, 179 election, if the asset was bought in 2018, we could write off up to $1 million of assets as long as we didn't invest more than $250 million in those assets. Under current law, both of those numbers went up. The maximum amount went up by $20,000. The maximum amount of the investment limit went up by $50,000. So as long as we fall under those, we can write off 100% of those items in the year that we buy them and place them in service, reducing our taxable income by that amount. The next third line down there talks about can pick an amount to get the desired sweet spot. What does this mean? We have taxable income and we want to manage that, level that. We can pick, like I said earlier, any portion of that $200,000 tractor that we were going to buy, or the $100,000 tractor we were going to buy, we can use 179 on 25,000, 50,000, 75,000, any number in there to get to the desired level of depreciation write-off in the particular year we're looking at. So this is a great tool, and your tax preparers often will sit and look at this with you. If you ask them some questions and say, I'd like to manage my taxable income instead of just wiping it all out. Normally what we see farmers doing is using the 179 to its maximum benefit, reducing farm income, essentially wiping out all self-employment tax, and paying as little taxes as possible. So the 179 rules, pick and choose. It is an election. We elect to use it basically on all or any portion of a particular asset, or even assets, more than one. Now the bonus depreciation, under current timing, it is the same, 100% deduction against business income, no limits. Under 179, there are some limits. You can't go above and beyond net farm income. Bonus depreciation can offset other things, such as royalty income, other off-farm income, etc. Bonus depreciation is assumed unless you elect out it's going to be applied, and it does go down. It will decrease to zero by January 2027. Right now it's at 100%, and over the next few years it stays there and then goes down. Here's the rules. So we have 100% for 2018 through 2022. Applies to both new and used property under current law. It drops to 80%, 60, 40, 20 in 2026, and then goes away in 2027. Now, bonus depreciation has been going to go away several times over the years. It has never gone away. It very seldom ever gets in that 80 to 50% range. We'll see what happens this time. But right now, these are the rules that we expect the sunset to apply. So for the next 5 years, we essentially have 100% bonus, so we write off 100% of it using bonus, 100% of it written off using 179. Now the neat part, or the one part about bonus, it does not apply to a particular asset, but let's say you bought a lot of machinery and equipment, it applies to all the machinery and equipment, or you can elect out of all the machinery and equipment for that particular year. So you have to pick a class to elect out on. So like I said, bonus must elect out of bonus on certain classes, so 3, 5, 7, 10-year class life assets. Bonus depreciation can and will offset W-2 wages as well as other income such as royalties, capital gains, etc. One other thing that does happen with 179, if we take a pickup or truck and we're going to use it for business use and we later decide to use it for personal, no longer business, we have to recapture the excess depreciation that would have occurred had we used makers or regular depreciation. Bonus depreciation, anytime you convert to personal use, it does not require recapture of excess depreciation. So it gives us some more options, alternatives, opportunities for tax management. So here, let's remember that 179, elect to use one specific asset, cannot create a farm loss, but can offset W-2 wages. So when you get to a certain level there, you cannot use 179 to go below zero on the Schedule F. Any excess is then carried over to future years. Like I said earlier, conversion to personal use causes recapture of the excess depreciation. So what's the rules here? Some things to think about. From 2018 to 2022, looking at 179 in bonus, they are equal. They are not equal in terms of the benefits and the drawbacks. For example, that business use dropping to 50%. Be very careful. There's an example that I've included here of what does occur. So we've got a pickup. In year one, we use bonus to 50,000. On this 50,000, we use 179 on it. If we depreciate it regularly, year one, 7,500. Year two, 12,750. Let's say in year four, we take the pickup. It's no longer going to be 100% business use. We're going to use it partially for business. We're going to have to pick up the excess amount. So basically, we have to come back and adjust the basis in year 4 of those two assets and then depreciate them the rest of or that amount of depreciation is recaptured as ordinary income if we use 179. Bonus, we would not have had to recapture any of that income. Consequently, if you look at it, bonus versus 179, you've got to weigh out what it is you're looking at doing in the future to determine your best option. So that covers the depreciation. Now, net farm or farm net operating losses. Another tool for adjusting net farm income in the year or in a year. Basically, we have a net operating loss. We're looking at, if we carry it back, applying that loss, getting a refund. If we expect income to be very large in the future, or we had very low income in the prior years, it may not be beneficial to carry it back, simply carry it forward. So you can be carry it back 2 years as an option, or electing not to carry it back, simply carrying it forward until it's used up. The amount allowed as a deduction in the year that it is carried to is limited to 80% of taxable income. So if you had $100,000 of taxable income and you had a $120,000 net operating loss that occurred this year, you carry it back to that year where we had the 80,000. We're only allowed to use the 20% of our taxable income in that year. So like I said, if it's 100,000, you're only allowed to use 80,000 to offset that 120,000 net operating loss. So what you've got to look at, is there a need for a refund resulting from a carryback? So we had lots of income. We're not expecting income to be large in the future. Then we want to carry it back. If all our expectation is larger taxable income in the future, we want to carry it forward. The old rules also stated that we had to use it up within 20 years or it expired. Well, now it can be carried forward indefinitely until it is used. So it gives us some opportunities. We lose some on the carryback because it used to be 5 years. Now it's just 2. We used to get offset 100% of taxable income in any year carried back to. We can only offset 80% in any year it's carried to, whether it's back or forward. So we lost a little bit of that, but we did gain in the fact that we can carry it forward and until it is used up. It doesn't disappear. Another tool that gives us some opportunities that we don't really think too much about is farm income averaging. It does reduce current year elected farm income. We elect amount to carry back to 3 prior years. We look at increasing then the taxable income in those years that we carry it back to. So we're looking at in prior years we have low income, low tax brackets. And what it essentially does is helps level taxable income over time. Now, we've got some examples here and a little more discussion of how this works. So if we're looking at net farm income this year, so we're 2018 taxable income and is very high. And we look at prior years, the 15, 16, and 17 tax years, we had some room in the 25% bracket to absorb some of this excess income. What you would want to do is fill up the 25% bracket in all of those years. Well, it is limited to has to be spread equally. So if you look at 2015, that was when we had the least amount of room. So we can only apply $20,000 for each of 15, 16, and 17. So we can move back $60,000 from the current year, tax that at a lower rate than the high income in the current year. So we have a large amount of income, taxable income this year. We're going to move $60,000 of that from 2018. We're going to put $20,000 in 2015, 16, and 17. What it does is it reduces or lowers the tax bracket, the tax bite, those 3 years, or by increasing those 3 years, we lower the tax bite in the current year. It does not impact self-employment tax, nor does it impact investment income tax. Usually those are extremely high, and if we're in that scenario, we may want to move more than just what's in the 25% bracket. But it does give us, again, an opportunity to think about. So this is one where you need to bring this up to your tax preparer. This may be an option. It may have some benefit if we have a large amount of income that pops up in the current year, either through higher cattle prices, better wheat crop with higher prices, etc. One of the slides I failed to get in here was the tax planning looking at retirement. Let's quickly cover those, even though they're not here. Basically, the retirement options are some of our retirement, such as IRAs, and there's several of these that apply to self-employed individuals. You make the election in the year, right at the end of the year. You have until April 15th to make a contribution. That contribution is tax deductible on the return. It can reduce your tax by varying amounts. A traditional IRA can drop it by $5,000 if you make a contribution to that IRA by April 15th. You get a deduction on the current year tax return. So there's some things to look about. So retirement planning are some things to talk about with your tax preparer. Again, it reduces taxable income. So wrap up, tax planning, year-round, everyday job. Doesn't matter if it's the beginning of the year, end of the year. There's things that we can do now that will impact end-of-year options, also future years. Need to have a basic understanding of the law, the rules. When you don't know, ask questions. It is wise no matter what time of year it is. Don't talk to your tax preparer. Professional advice always is good to seek whenever you're making a business decision. It will help you make sound business decisions. And you never want to let the tax tail wag the business dog. We want the business to make sound decisions. When we do, then let's manage your taxes from that decision. Year-end tax planning, always a benefit. It will help level taxable income over the lifetime of the business. And when we do so, we reduce the overall tax bite over those years. We will have a minimum or reduced or level of tax paid over the life of the business if we can manage and level income. So with that, here's a link to the evaluation. Again, thank you for tuning in, listening. Appreciate the opportunity to be here, Brent. Let me know when we need to do this again. My email address is at the bottom of the page. If you have questions on this, contact Brent, contact me. Do our best to answer your questions.
Thank you, JC, for all this good information. And thank you, everyone, for filling out the survey link. We really appreciate your feedback. I would like to remind everyone that our next webinar, it will be March 26th, and it will be over Oklahoma rental rates for cropland and pasture. Thanks, and we will see you then. Goodbye.